Do you ever wonder if there's just too darn many ETFs? Well, we have Martin Small, head of iShares, to tell you what he thinks about it, and you might be surprised. But here's something you might be surprised about too. Who does the most activity in ETFs? That would be you.
Financial advisors are really the power users of ETFs. Roughly 2/3 of our US iShares business basically comes from financial advisors and traditional retail channels. To give you some flavor of what advisors are doing with ETFs, they're replacing underperforming mutual funds, they're controlling the cost of their investments, and they're also using ETFs as part of portfolio construction and asset allocation with an eye towards those as the drivers of long-term return, and ultimately starting to disfavor manager selection and security selection. And just some figures around that. 81% of advisors are using ETFs in their portfolios. Over 50% of them are planning to use more ETFs in their portfolios. And roughly 60% of them are blending active and traditional passive strategies together for better portfolio outcomes. And just consider this in terms of the growth of basically retail adoption in ETFs. Retail ETF net new flows in 2011 were about 71 billion. Last year in 2015, they were 235 billion. That's a 230% increase over the last couple of years. One of the largest growing segments is actually the institutional asset manager that is using ETFs as part of their strategies. If you look at 13F holdings or you look at multi-asset funds, you'll often find ETFs as the 1, 2, or 3 number top holding. And that's because tactical asset allocators are using ETFs to basically grab different slices of global markets. So if they want to move through preferreds or Brazilian small cap, the easiest, most efficient way to do that is through an ETF. I think the biggest and fastest growing category is going to be non-cap weighted ETFs or smart beta ETFs using factor-based strategies. And this is really where we see tremendous growth in the industry. And so, for example, smart beta ETFs are just ETFs that deviate from traditional market cap weighted indices to produce an outcome, like reduce risk, generate higher income, or outperform a cap weighted benchmark. And in that way, smart beta ETFs are just like mutual funds in that they're trying to achieve an outcome that is different than the index, but they come with the benefit of the ETF wrapper, which is low cost and tax efficient. I think you're going to see the smart beta category be $1 trillion category in just a handful of years. And embracing things like minimum volatility strategies have been particularly popular over the last year, where they were taking in 9-10 cents on the dollar in new ETF flows. And I think you're going to see that with ups and downs in the market, min-vol strategies helping smooth the ride as really the gateway for more and more smart beta offerings. I used to think that there were too many different flavored ice creams, but then I tried black raspberry chocolate chip and it was really, really good. So I think that choice in ETFs and choice in investment products, it's not just an ETF thing. There are something on order of 8,000 mutual funds with 24,000 different share classes from 800 fund sponsors. There are 44,000 municipal issuers. There are 9,000 securities issued by the top 10 corporate issuers, and that compares with about 1,900 ETFs. But I think cost and competition is generally good for investors. And as new entrants bring new offerings, that's generally good for the market, it's good for the industry. But I think investors are really focused on the right things. If you look at where the money is in ETFs, it's in the 100 largest funds that are broad-based exposures, super liquid, very efficient, generally good for investors. So I generally think investors get it right. They're able to filter through what is a very competitive and constructive set of offerings.